Well, the president is being pushing to drop these tariffs, but the trade war does go on. And then all of a sudden you have the release of this tape last night on CNN that shows the president talking to his lawyer about paying off in one way, shape, or form a former Playboy model. Now, you would think that 1-2 punch would rattle stocks or at least rattle them in the fear of the unknown, but as has been the case of late, nothing even hinting of that. What's going on here? What does it say about the resilience of this market? Maybe it's just sloughing it all off. It's all going to go away. To Rosecliff Capital founder, managing partner, Mike Murphy. We got Moody's chief capital markets economist, John Lonski. And last but certainly not least, Fox Business's Kristina Partsinevelos. Kristina, on that, it is remarkable how resilient the market is in the face of wave after wave, you know?
We've been seeing this for months now, so is it no surprise these tapes came out, and then once again, it's not going to really affect markets? I think there are other factors playing into it. We have passive investing that's been a trend for quite some time, kept the market relatively steady.
Automatic.
Yeah, exactly. And so you're not seeing as much volatility, and these funds, ETFs, are just growing larger and larger, and there's more of them in the market, and that does play a role when you're talking about trades. And then accommodative bank policies, too. All of this are contributing factors, and maybe the unwillingness to really care that much about what the president is doing.
Wow. She's talking about exchange-traded funds and all that. But, Mike, when you look at this and advise your clients through all of these cross-currents, they must get nervous. They must need some hand-holding a little bit. What do you tell them?
People get nervous, Neil, but I think the underlying factor here is that the U.S. economy is in the best position it's been in years. We have small businesses that are doing great, medium-sized businesses that are doing great, low unemployment, so people feel good. And when you see the S&P 500 reporting earnings and they're coming out with solid growth, blockbuster growth from a lot of these businesses, that's what's ultimately supporting the market. So I think there's a lot more room here, because if you look at tariffs, for instance, what if you look past that? What if the U.S. now ends up, what if President Trump ends up getting fair trade deals across the globe? What do U.S. profits look like under that scenario? I think they're a lot better, so the market can go higher.
What do you think of that, John?
Got to be cautious, because I don't know of many business executives right now that think that these tariffs are a great idea. They're worried about this in the auto industry, those that use steel. Remember, Whirlpool was initially in favor of this tariff placed on appliances from Korea. They've changed their mind 100%, it seems, in part because of higher steel costs. Steel costs right now, by one measure, are up.
And by the way, we did all of this for Whirlpool, if you think about it.
Yeah. Steel costs up 35% to 40% for the year to date. Industrial metals, on average, are down 6.5%. And that's one of the reasons, the latter, why Treasury bond yields are lower than what we had expected not too long ago. We're getting help on the interest rate front. We saw the housing numbers. They're lousy. So you're trying to tell me that the 10-year Treasury yield can stay at 3% or higher for an extended period of time? I say no until I see more strength in an area like housing.
Well, you know, Kristina, that's one of the arguments that people have used to look at the half-full glass here, that all of this leads to slower than expected growth, and that keeps at bay an aggressive Federal Reserve. What do you make of that?
I don't know if that's necessarily a great way to say that, you know, with the Federal Reserve, and you just weighed in on this in terms of interest rates, I don't think necessarily we can use that as an excuse. But I would actually like to get your input more on just in terms of whether the Federal Reserve should actually listen to any of the rhetoric in the market that's slowing down interest rates. We expect 2 more hikes coming up in the next little while. And when you're bringing up the market, I don't know if that's a sign just yet for it to slow down. There's a lot that could still happen right now, especially with the trade wars. It's hurting a small portion of the market right now. I'll say that, especially farmers, but the uncertainty is what is causing.
I want to add something here. Because of higher materials costs, we're talking about steel, we're talking about lumber, companies have less money with which to hike wages and salaries. And without faster wage and salary growth, you're going to find big ticket items like housing are going to be hurt.
But their tax cuts have dwarfed
that,
right?
but that's kind of like the half glass, the glass half empty approach. Look at things, because I would push back and say that we have so many positive things out there to outweigh that. Yes, tariffs act as a tax short term on companies, and you're seeing companies like Whirlpool and the automakers get hit on that and produce lower earnings on that. But the overall picture is a stronger economy. If you talk housing starts, you have to talk about the point you're coming from. You're coming from all-time highs or 100-year highs on housing starts.
No, you're not. No, you're way off even compared to where you were in the 1990s still.
The housing starts.
Housing starts, I can show you the numbers. numbers, so they're going to be down by more than 10%, maybe 20% from where they were back in the 1990s. But they haven't fully recovered from the housing crisis starts.
Housing starts haven't recovered in the last 10 years. But how about, so you're saying that housing isn't lower than where it was?
Well, existing home sales are still under where they were during the housing boom.
Well, we do know that the second quarter, the second quarter ended on a weak note. The second for housing, and I'm wondering whether whatever we see on the GDP for the second quarter on Friday, that's a short-lived sort of a hooray.
I don't think it's going to be 4%. Did you see that in terms of looking at how you can measure it differently, and that it's going to climb to 4%? There was a chart about that, and I don't think it's going to be going there. And like you mentioned, the uncertainty, wage growth is not happening. It's across the board. I think Boeing even mentioned in their outlook. A lot of companies are starting to mention in their outlook they're uncertain about where the market is going to go. I know that you said tariffs is a tax, and it's a small portion right now, but that uncertainty is what's weighing. And when we look at the numbers, why is the trade deficit a scorecard for the president's
it doesn't
success?
necessarily have to be.
But that's the way he's treating
one thing, when you talk to investors at home and you talk about uncertainty, like I would say, tell me one point in history where it's been a certain market.
No, of course.
There's always uncertainty out there,
if you're
but we're
in business,
talking about.
You're not certain.
So we're talking 4% GDP growth. We were on this program a year ago saying, will we ever see 3% GDP growth again? Maybe we'll never see it again. Now we're talking about maybe 4. I would say.
Well, we did have that for one quarter.
Yeah,
it's just but it's not repeatable. That's what history has told me. It's a tough time to repeat.
This is not the sign of things to come. That's what it comes down to. You'll have a great second quarter real GDP, but I'm pretty certain that you're not going to see this repeat itself over time. I wouldn't be surprised in the third quarter if it goes under 3% again.
You don't think in a full employment environment right now that eventually businesses are going to have to cough up more money for their workers?
Well, they might have to, but quite frankly, they're
full glass.
They're meeting production quotas, whatever it is they have to do in order to satisfy consumer demands with the existing wage structure. And let's not forget, this is a much older workforce today. Believe it or not, something like 20.
Why are you looking at me as you say?
Well, I should look at myself in the mirror. Right. But it's incredible. Never before.
Murphy gets a pass. Kristina gets a pass.
23% of household survey employment consist of Americans aged at least 55 years of age. And as it turns out, when you get older, we know this, Neil, the wage increases are not as great as when you were young.
But what I'm saying, I agree with what Michael's saying, and Kristina, what you thought on this, that the next step after you get full employment or so many people, there are more jobs than there are people to fill them, is to pay more for those.
Absolutely.
Pay more or what? Immigration? Do we start talking immigration at this point?
I don't know. I'm just saying that you will see.
But we have to. We have to.
Productivity's gone no place throughout most of this recovery. If productivity takes off, then you can make do with your existing
Do you think our expectations have been too high for productivity? I know this is something that we talked about, and it's been slowing down. It's not climbing higher. Maybe it's it's that high that we need to set a new base, a new threshold.
Maybe a lot
benchmark
of managers out there are going to have no choice but to go ahead and try to become more productive, get more out of their existing.
Probably the older ones.
Yes, definitely. Oh, yeah. We start at a high level of productivity.
Exactly. So you're saying, Mike, what then?
I'm saying that small and medium-sized businesses across the country feel better today than they did a year ago or any time over the course of the last 10 years. I think pulling out one data point is dangerous sometimes. I look at the overall marketplace right now. I would much rather be a buyer of the U.S. market than a seller, because I think the companies, when you look at earnings you're seeing from companies like Google, we'll see Facebook later, you're seeing a lot of growth in a lot of companies. Tariffs weigh on certain industries, yes, but if you're going to pull out of this market right now, Neil, and wait for a pullback, let me know when you're getting in. But if you know when that time is, right. No, I would say stay invested. It's a great time to be invested.
You're talking about stay invested in small, medium caps like the Russell 2000?
I think you can have a diversified portfolio. The Russell focus on U.S. businesses has outperformed as of late. But so I think if you're someone at home saying I have one place to invest in the S&P 500, the top 500 companies in the U.S. Some sectors will underperform others, but overall, I think it's a great place to be for long term.
So you're not buying at a high, and if the longer you keep it, the trend is your friend?
Yes, and the growth is there. You can't argue that.